Warren Buffett sounds the alarm, and it's no small warning. A whopping $1.4 trillion debt-fueled storm about to slam into the U.S. real estate market. And believe it or not, impact is going to be huge. It's like watching a dark cloud forming on the horizon, signaling a storm of epic proportions. Now, if you're thinking, how will this affect us? Well, this storm is not just about some rain and thunder. It's not just talking about numbers. Think downtowns are turning ghostly, foreclosure rates are skyrocketing, and commercial property owners are taking a gut-wrenching hit. It will leave no stone unturned. A storm is coming. For those unfamiliar with Warren Buffett, he's the CEO of Berkshire Hathaway and has a net worth of over $100 billion. He's known for his value investing strategy and has a proven track record of successful investment decisions. So when he talks about real estate, it's worth paying attention. Warren Buffett has recently issued a chilling warning about the real estate market. He's talking about a storm, a massive storm, that's brewing just around the corner. This debt-fueled tsunami storm is set to devastate like nothing we've ever seen. However, the current market conditions are similar to what we saw in the early 2000s before the housing market crashed. But wait, why is Warren Buffett so concerned about this? You see, the key player in real estate profitability is none other than the interest rate. As these rates climb higher, those who once secured loans at bargain rates are now grappling to keep up with their mortgages, sinking into financial troubles. It's a rough tide to navigate for anyone. It's exhausting and futile trying to swim against a strong current. So that's where things start to go downhill. Non-recourse loans are reaching maturity, and their funded properties have depreciated below their initial purchase prices. It's the perfect storm brewing, setting the stage for a wave of potential foreclosures and overwhelming financial hardships. The fallout is looking daunting. The struggle is real, my friends. Unlocking the real estate market trends. In the midst of this chaos, the UBS Global Real Estate Bubble Index 2023 recently revealed a significant shift in the real estate landscape, confirming the warnings here and there. We're talking about a decline in housing market imbalances. From mid-2022 to mid-2023, average house prices fell by 5% in major cities. Yep, you heard that right, a dip in prices. Rising financing costs, with mortgage rates tripling since 2021 in most markets, have put a dent in house price growth. Annual nominal price growth in the 25 cities analyzed hit a standstill after a booming 10% rise a year ago. When we adjust for inflation, prices are 5% lower than in mid-2022. Now, let's talk about individual cities. Frankfurt and Toronto, once high on risk scores, have seen actual prices tumble by a whopping 15% in the last 4 quarters. High market valuations and shorter mortgage terms have pressured prices in certain cities. But hey, not all cities are facing the same storm. Interestingly, inflation is a double-edged sword here. It has driven down imbalances due to declining house prices, but hasn't necessarily made housing more affordable. The living space that's financially doable for many folks is still 40% lower than the level in pre-pandemic. The repercussions of this storm won't be confined to the real estate industry alone. Its reach will be far and wide, akin to a spreading wildfire. Regional and community banks are in for a rough ride, with losses in the commercial real estate sector. When they feel the crunch, it sends shockwaves through the entire economy. Small businesses will struggle to access credit, economic growth will take a hit, and the ripple effects will infiltrate every nook and cranny of our financial world. Now, let's zoom in and examine the latest trends in the real estate market, primarily focusing on the perspective of real estate investors. As per recent data, real estate investors are taking a notable step back, purchasing 45% fewer homes compared to the previous year. This decline surpasses the overall drop in home sales, making the most substantial decrease since 2008, except for a brief period when they plummeted by 48%. The market share for investors has dipped to 16%, a notable drop from its all-time high of 20% in Q1 of 2022. Areas like Phoenix and Las Vegas, which saw a booming real estate market during the pandemic, are experiencing the most significant declines in investor activity. The frenzy triggered by the pandemic, which led to a surge in home buying and rental demand, is now subsiding, making investing in homes less appealing. Investors are shifting their focus towards low-priced and single-family homes, even though the limited inventory has caused a year-over-year decline in purchases within this category. Interestingly, offers from hedge funds have noticeably diminished, tilting the market from being investor-dominated to more accessible for local buyers. In terms of monetary value, the reduction in investor purchases is substantial, accounting for $36.4 billion worth of homes bought in the second quarter, reflecting a 42% decrease from the previous year. The median price of homes purchased by investors during this period stood at $470,120, similar to the figures from the previous year. When examining market share, investors bought 15.6% of homes sold in the U.S. during the second quarter, which is a decline from the 19.7% seen the previous year. This clearly signals a significant pullback from the robust investor activity witnessed during the pandemic. You might be pondering who'll take the hit amid this storm. Is it the big banks that will feel the pain? The big investors? Actually, no. This storm will hit the little guys the hardest. It will be the individuals and organizations involved in real estate operations and lending who find themselves facing the repercussions of lending at low rates. They will be the ones left with personal guarantees and on the brink of the possibility of financial insolvency. Prices for residential real estate have been rising steadily over the past few years, but incomes have yet to keep up. This means that housing is becoming less affordable for the average person, so the demand for housing could begin to fall. When demand falls and prices continue to rise, a dangerous bubble is ready to burst. The buildings will likely stay, but the owners might not. For the past 15 years, the real estate market has been thriving on massive amounts of cheap debt. Low interest rates incentivized by a debt frenzy, pushing real estate values to unprecedented heights. So how does this affect you as a homeowner or potential home buyer? If you're currently in the market for a home, think carefully about your decision and do your due diligence. Buying a home during a bubble could mean paying more than it's worth, and if the bubble bursts, you could end up with a property worth less than what you paid for it. If you have questions regarding this, comment down below while we continue to elaborate on how this commotion will affect your decisions. Imagine you bought a property for $1 million, put down 20%, and borrowed the rest from the bank. When interest rates were low, it seemed like smooth sailing. But as the speeds climbed, the debt service coverage ratio, DSCR, is falling out of equilibrium. A substantial portion of commercial real estate loans is on the verge of resetting at considerably higher interest rates. If the interest rate on a loan surges from 5% to 7.5%, the property might no longer generate sufficient income to cover the debt, making it financially unviable. And it's not just the rates. The trend of working from home, accelerated by digitization, is hitting the demand for office spaces. Less demand means falling rent prices, adding to the storm's fury. Also, this might not be the best time to sell for those who own property. You could get a high price for your property, but with the impending market crash, holding onto your property might be a better financial decision in the long run. Buffett's secret? A disciplined, long-term investment strategy, picking solid companies and focusing on steady, prolonged growth. Amidst the whirlwind of new investment techniques and algorithms, he stays committed to simplicity and substance, brushing off the market noise that often leads others to panic. Warren Buffett understands the critical difference between buying and investing in real estate. He's not averse to real estate investments, having put money into real estate investment trusts, REITs, over the years. However, He acknowledges that managing real estate is more like running a business, which needs to be aligned with his expertise and focus. Real estate can be tricky, requiring scale and complexity to amass significant wealth. Many need to pay more attention to the hands-on nature of being a landlord, and the misconception that it is a passive investment often leads them to an eventual exit. On the other hand, investing in real estate passively is a whole different ballgame. It allows investors to reap the rewards of this profitable asset class without getting entangled in daily management. The FTSE Narrate All Equity Rates Index has showcased impressive performance, outpacing the S&P 500 in total returns for a significant portion of the past 2 decades. The numbers speak for themselves. An average total annual return of 13.1% versus 11.1% for the S&P 500. Warren Buffett, the maestro of investments, knows where his strengths lie, and he sticks to his realm of expertise. His commitment to a strategy that works is a testament to his unparalleled success. So, what can we learn from Warren Buffett's warning about the real estate market? For starters, we should always be aware of market conditions and do our research before making any significant investment decisions. We should also be mindful of how our decisions could affect our financial future and make intelligent choices that will benefit us in the long run. Warren Buffett has been turning heads over the years with a jaw-dropping percentage of annual return. So if I were you, I would note Warren Buffett's investing moves. The Golden Rules. Buffett, primarily an equity wizard, has some investment philosophies that can be adapted to any asset class, including real estate. Here are 5 golden rules inspired by Buffett that you can tweak and use for real estate investments. First, number 1, be cautious with your money. This is no Vegas casino. It's your hard-earned money we're talking about. Think about where you spend your money while investing. Research, visit locations, do homework, and never invest just because your buddy says so. Be smart. Next, rule number 2, be a long-term investor. Think long-term gains, not quick flips. Real estate is a marathon, not a sprint. Hold on for the ride and reap the benefits. Rule number 3, buy from credible and stable builders. Don't gamble on your builder choice. Look for a track record, meet the people behind the project, and opt for customer-friendly builders. Trustworthy builders can make a huge difference. And then there's rule number 4. It's better to buy a wonderful property at a fair price than a fair property at a wonderful price. Quality over a bargain deal. Be bold in paying a bit more for a gem. Trust me, it pays off. Lastly, rule number 5, take advantage of market conditions. Know the market, seize opportunities, negotiate like a pro when it's a buyer's market, and always do your research. Innovative moves in the market can work in your favor. So my friends, it's time to batten down the hatches and prepare for the storm ahead. Warren Buffett is rarely wrong, and when he sounds the alarm, you better believe things are about to get real. This storm is coming, and it's time to strategize, analyze, and position ourselves to weather it like the seasoned investors we are. So watch our other videos for more in-depth analysis, expert opinions, and actionable tips on navigating these stormy waters. Remember, the most incredible opportunities often arise amid chaos. Until next time, click, like, and subscribe. Happy investing!